What a day, what a crazy day in the markets. Gold hitting another record high on a batch of weak economic data coming out of the US and European stocks plunging. Joining me today is Jim Wyckoff for a very special edition of Technically Speaking. Stay tuned. Hi Jim, nice to see you again this week.
Good morning, Daniela.
All right, Jim, break it down for us. What's going on in the markets?
Well, you are seeing strong safe haven investment demand for the gold market. It is high anxiety regarding the European Union. We had European financial stocks plummet today. That spilled over into the world stock markets. The world stock markets, and specifically the U.S. stock market, continue to be a very good gauge of investor risk appetite. And as we see stocks sharply lower in the U.S. today, we are seeing strong demand moving into the gold market. And as long as we see stock market shakiness, as long as we see economic and financial uncertainty that is keen right now, if that continues, you're going to continue to see money moving into the gold market.
All right, Jim, as we're speaking, December gold last trading at $18.29. What's next?
Well, the next upside objective is 1850. Above that is psychological resistance at 1900. And then you have major psychological resistance at 2000. Importantly, Daniela, the path of least resistance has been and will continue to be for the gold market sideways to higher until we have some early technical clues to suggest otherwise. Now, late last week, we had a corrective pullback in prices, which was not unexpected. That corrective pullback and any future corrective pullbacks are actually healthy because they suggest that the market is just regrouping, getting ready for that next move higher. History has shown the past several months and even the past few years that significant price pullbacks in the gold market have proven to be bargain buying opportunities. And as we move still higher, that's still proving to be the case.
All right, good advice, Jim. Back on the topic of Europe, we saw stocks plunging over there. How much of an impact will this have on the U.S. economy? Is it too soon to tell whether there will be a spillover effect?
My bias is that there will not be. However, the stock market is going to be the barometer of investor assessment of this situation over in Europe, and we're seeing, prices weaker today. There is a worry that a debt market contagion could spread from Europe to the U.S. My bias is that won't happen, but remember that markets and traders tend to think the worst will happen, and when it generally does not. But that's still the mentality of a trader, to think that the worst might happen, and that's kind of what we're seeing right now.
All right, Jim, final thoughts for traders out there today.
Well, it's going to be when we have strong upside price action like we've seen in the gold market, you do see the potential for strong downside corrections. The market's volatile. It's probably going to continue to be volatile. So that needs to be, the investor needs to be fully aware of that and expect that.
All right, Jim, we'll see you again next week. Thank you. On the line with me now, however, is george-gero of RBC Capital Markets. George, can you give us your take? What's going on in the markets today from your point of view?
Well, in the general markets, of course, you have a large percentage down, probably 4.5% in the average stock, and you have worries about international holdings of currencies. You have European bank worries. You have worries about gold maybe being the only haven left as an additional currency, while the euro holders are worried, the dollar holders are worried, and this turned into a possible repeat of 08 and 09.
Okay, so is it time to panic?
Oh, definitely not time to panic. To the contrary, usually these large sell-offs caused by worries are eventual opportunities.
All right, George, now that I have you on the line, would like to speak with you a little bit about CME hiking gold margins. It's a move we saw last week. Is this something that could be repeated?
But there is a possibility, but this last move has not been as volatile, and the margin increases are based on volatility, not prices. And so you've had a steady increase in price, and older longs, I would say 60 to 75% of the longs have been older longs based on open interest figures I've been watching for years, are not going to be impacted because they have plenty of equity. And so if there is another margin increase based on span margining, which is the volatility index basically, you could see a day or two, as you have in the past, of a setback. But if the fundamentals are there and the ETFs are fully paid anyway, for the most part for retirement and pension type accounts, and mostly the ETFs require 50% margining. So therefore, I'm not so sure that it's going to be that meaningful, especially since traders who need or want to be long gold at these prices have derivatives, options, and offshore possibilities where there is no margin increase.
All right, so not as impactful as last time.
Well, it'll be impactful only for a short period of time, just like all the last margin increases.
All right, great, George. Thank you for joining me, and thank you for watching. You can email me your comments and questions at newsfeedback@kitco.com.